Morning, guys. It's Wednesday, June 18th, 5:26 a.m. Central Time. Grain markets are mixed this morning. July corn futures up 3/4 cents at 432 1/4. July soybeans down 1 at 1073. July Chicago wheat up 2.5 at 551 1/2. July Kansas City wheat up 3 1/4 at 551. July spring wheat is up 4 cents at 634 3/4. Mackenzie, we're taking a couple days off this week.
We are. Isn't this great?
Well, the markets are closed tomorrow in observance of the Juneteenth holiday, so we're not going to do a show tomorrow. We're going to go ahead and make it a 4-day weekend because we don't take any days off. And quite frankly, we're sick of getting up at 3:45 in the morning to do this. So we're going to take a couple of days off. You guys will survive without us, I promise. On another note, if you have not subscribed to the YouTube channel, you should. Our tiny little channel has just over 21,000 subscribers. We'd love to get to 25 or 30,000. If you ever get to 100,000, they'll send you a plaque. I'll be long retired by the time that happens. But if you guys haven't hit the subscribe button, do so and help us out. All right, let's start off with Make America Healthy Again.
So, more than 250 agricultural groups are seeking to provide input to the Make America Healthy Again Commission. The groups argue that last month's MAHA report contained multiple inaccuracies that have raised unnecessary concerns about the safety of the nation's food supply. The report suggested that pesticides and insecticides could potentially pose health risks. In response, the organizations, including the American Farm Bureau Federation and several agricultural trade associations, sent a letter to the U.S. Health Secretary, the Secretary of Ag, and the EPA Administrator. In the letter, they urged the commission to allow public comment and to formally include agricultural representatives in future reports. The commission will release its next report in August.
Make America Healthy Again right now, of course, is not a law. It's basically a policy proposal or some sort of framework. It outlines recommendations for things along the public health spectrum, nutrition, food system reforms. So it could shape actual policy at some point in the future if Congress decides to adopt it. There are a number of potential impacts as far as ag is concerned. I threw together some bullet points here. Possible reduced demand for processed ingredients, lower ultra processed foods, demand for high fructose corn syrup and refined soybean oil could take a hit. Pete Meyer told me that behind closed doors, a lot of the manufacturers of processed foods got very nervous when this report came out because RFK through this is seeking to reduce a lot of that and, of course, make America healthy again. There's going to be some changes to SNAP and school programs, things along those lines. I think we've already seen some changes to the SNAP programs. Sugar and oil backlash, increased scrutiny on added sugars and refined oils could lead to new labeling rules, taxes, potentially subsidy reforms. They could redirect farm subsidies away from corn and soybeans toward things like fruits, vegetables, and other ag practices. So that could be a big one potentially. Biofuels, they're talking cleaner air initiatives, which could support ethanol and biodiesel, but it was kind of vague, is my understanding. So there's a number of potential impacts here. Where does this actually go? I don't know, but the farm groups want their say. The Farm Bureau Federation, probably all the lobbies out there want some sort of input here because, quite frankly, they're probably nervous about some of the impacts here. I don't know if RFK's thing here is all a pipe dream or if it becomes reality, but some people are obviously concerned.
The Senate has released its version of the tax package, part of President Trump's One Big Beautiful Bill. The release comes about a month after the House unveiled its version of the bill. Both versions extend the 45Z tax credit through 2031. The Senate bill allows foreign biofuel feedstocks, but reduces the credit by 20% for fuels made from them. Both the House and Senate bills exclude emissions from indirect land use change from the credit calculation, making it easier for corn-based ethanol to qualify. Both bills also make transportation fuels derived from livestock manure eligible for the credit.
I don't like what they put forth here because even though you're going to see a haircut with regard to the credits that foreign feedstocks receive, they're still going to allow foreign feedstocks. This is something that was sent out by the American Soybean Association and their president, Caleb Ragland. He said this: the Senate 45Z proposal turns its back on the Trump administration's Farmer First American Energy Dominance agenda, which was highlighted through EPA's strong renewable volume obligations proposal that U.S. Ag applauded. RVOs and the 45Z tax credit should be seeking to achieve the same goals for U.S. farmers and domestic biofuel production. And instead, the Senate budget reconciliation language seeks to provide U.S. taxpayer dollars to foreign feedstock competitors at the expense of soybean farmers. Our friend and contributor Pete Meyer said something along the same lines. He said the allowance of foreign feedstock, regardless of the 20% haircut on the tax credit, is the polar opposite of the narrative put forth by the EPA. In its biomass-based diesel proposal last Friday, the EPA highlighted its intent to eliminate foreign feedstocks, while the Senate tax package seems unconcerned. Mixed messaging just a week after a positive sign from this administration. So the administration, with different proposals and bills, kind of talking out of both sides of their mouth with the foreign feedstock stuff. So we hope that they get this resolved. This is a potentially a huge positive item for U.S. ag if we're using more U.S. feedstocks for biofuels, but we've got to get the law and the policy correct.
Some U.S. weather forecasts have shifted drier. Still, both the Euro and GFS call for mostly normal rainfall across U.S. corn areas. Based on GFS data, our friends at Crop Profit estimate that U.S. corn areas will see 84% of their normal seasonal rainfall over the next 7 days. This number was above 100% yesterday. However, above normal rainfall continues to be forecast during the 8 to 14 day period. Temperatures across most of the region are slated to run above normal during the next 2 weeks.
There's still no perceived weather threat here, and this is why largely I believe the corn market has been under pressure. You've got mostly normal rainfall projected by both the GFS and the Euro this morning. 8 to 14 day. Yeah, it's not as reliable as the nearby stuff, but there's still no threat here. The temperatures are going to run above normal, and some farmers have told me, hey, this is a positive. We need the heat. And it's probably not going to be detrimental in any way, shape, or form. The Corn Belt, based on this is Euro Ensemble data, will run 5.4 degrees above normal on average over the next 7 days and 2.4 degrees above normal over the 8 to 14 day period. Speaking of past rainfall, it's been pretty normal and unexciting over the last 30 days. And that's part of the reason that the corn market has struggled. Now, I'm not telling you that you on your farm got rain. I'm just saying that on average, the Corn Belt has done pretty darn well. There have been some dry areas. You look at Michigan, it's been dry. Actually, parts of like northern Ohio have been dry, northwest Indiana into northern Illinois, parts of eastern Iowa into southern and western parts of Iowa have been dry. A little bit of South Dakota has been drier than normal, but still, you don't have a problem here on a national scale, and it's for that reason I believe that corn prices, especially, continue to struggle. You look at the actual rainfall totals expected over the next 5 days, and yeah, it's kind of minimal-ish for the Western Corn Belt in particular, but then things projected to open up during that 5 to 10 day period. So long story short, there's no weather threat, and corn prices in particular remain under pressure as a result.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about yesterday's premium video?
Had a bunch of charts yesterday about the corn situation, U.S., global, China, Brazil, Ukraine, Argentina, why the corn situation is tight. And I made a PDF download available. If you guys are seeking some actual real insight into the supply and demand situation from a whole bunch of different angles, we included that yesterday, and there was a PDF download. You could download all the charts and print them out or whatever. Pete Meyer is doing Sunday weather updates for us. He'll do another one this coming Sunday. And in the Sunday weather updates, they're short videos. And Pete basically says, hey, this is what the weather says. This is what the forecast looks like. And this is what it means for the market. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. No other fee, no other obligation. Nobody will try to sell you anything else. We just want to send you our info, guys. That's it. My cash grain marketing recommendations are included every single business day. You can sign up on your phone. It takes like 30 seconds. We do Apple Pay, Google Pay, Cash App, credit card, whatever you want to do. Give that deal a shot this morning, guys. I will forward you a copy of this morning's email.
The US dollar fell to a seven-month low versus the Brazilian real on Tuesday. The dollar has weakened as interest rates stabilize in developed economies, prompting investors to seek higher returns in emerging markets like Brazil. Brazil has attracted record inflows into its local currency bonds thanks to its central bank's benchmark rate of around 14.75%, one of the highest among major economies. This interest rate gap is a major driver behind the real's recent gains. Brazil's solid trade performance, especially in commodities, has also improved investor sentiment despite some fiscal concerns and new U.S. tariffs. Additionally, the real has gained technical momentum in financial markets, with many analysts expecting its strength to continue into next year.
This is a positive item for U.S. soybean prices. A weak U.S. dollar, especially versus the Brazilian currency, makes U.S. soybeans more competitive on the export market. Brazilian farmers become a lot less eager to sell soybeans when their currency is strong because they receive fewer reals per dollar, essentially. So, the soybean market, I would argue, certainly has been curiously strong, relative at least to corn and relative to wheat. And I think this could be a big part of the reason. This is the most important currency pair on the planet when it comes to row crops. When it comes to corn and soybeans, the U.S. dollar versus the Brazilian currency is the most important currency pair. It's not the dollar index. It's this one right here. And the dollar has been especially weak versus Brazil's currency.
USDA reported a flash sale of soybean cake and meal on Tuesday. U.S. exporters sold 120,000 metric tons of the commodity to unknown destinations for delivery during the next marketing year. Since the start of the year, exporters have sold 400,000 metric tons of soybean cake and meal through 3 flash sales.
If last week's EPA proposal regarding biomass-based diesel becomes reality, we will be reporting soybean meal flash sales like every damn day because we're going to have way too much of it. And that's going to be problematic, I think, at some point in the future. Cattle got beat up yesterday.
They sure did. Live cattle were $1.62 to $4.90 lower. Feeders really took a beating, with losses ranging from $5.30 down to $6.87. Box beef continued to head for the moon. Choice was up $4.40 at $3.86.51, and Select was up $5.07 at $3.72.54.
Outside markets fairly quiet this morning. We've got the Dow up like 7 points. The S&P's up a couple points. Treasuries mixed. U.S. dollars down. Crude oil's up 7 cents in the July WTI at 74.91. We're off for a couple days, guys. Have a nice weekend. We will be back on Monday.